Hello everyone, welcome back. Let's discuss debt restructuring negotiations, which, as you know, fill the front pages of newspapers. Think of Greece. In the summer of 2017, the IMF clearly said it wants Greek debt to become more sustainable before it channels funds into the country's bailout program. Think also of Puerto Rico's debt default in the aftermath of the Irma hurricane in the fall of 2017. Well, behind the scene and the front pages, you have complex negotiations involving not only the IMF and the World Bank, but also the Paris and London clubs, and of course, emerging market countries. That was my job for many years. Well, protracted and tense negotiations can last as long as 1 or 2 years. That was the case of Argentina regarding its sovereign debt restructuring negotiations with global banks. Well, in case of liquidity difficulties in debt servicing payments, a combination of time and money, that is refinancing and rescheduling, can provide liquidity relief. But there is a point beyond which a high debt to GDP ratio, typically higher than 100%, creates the conditions for a solvency crisis with a chain reaction, a vicious circle between downgrading, capital flight, and declining economic growth. That's the case of Greece today, where improving the debt to GDP ratio cannot be implemented without a debt reduction. The same story in Puerto Rico or also in Cuba. Well, when you have negotiations between the Paris Club and emerging market countries, you have all in all 21 people around the table, 20 creditors, and you have, let's say, one country's government. In London Club debt negotiations, you have hundreds of banks from all over the world, particularly in large countries such as Mexico, Brazil, Argentina, or the Philippines. And each bank, faces specific portfolio constraints as well as specific regulatory, tax, and legal conditions, hence the need for a flexible market-based menu approach to take into account these market conditions. The idea of the Brady Plan that was launched in the late 1980s and that has been applied to more than 20 countries, including Greece, a couple of years ago, is burden sharing. On the one side, emerging market countries must implement an IMF-sponsored program of tough economic adjustment, in plain English, austerity measures aimed at shrinking expenditures and reducing the financing gap. On the other hand, banks and creditors face a tough choice: lose everything or negotiating a debt reduction that can lead to a return to market access for the country in trouble. Often that works well. Think of Mexico or Chile. Sometimes it doesn't work. Think of Zimbabwe or Cuba. Well, this Brady Plan, which was launched by the US Treasury to meet the challenge of a growing number of debt defaults in Latin America, in Africa, and in Asia, has as a whole idea to provide banks with incentives to accept, in fact, to swallow large haircuts, roughly on the order of 35% of face value. But the only way to make it acceptable or palatable is transforming the remaining claims into a senior debt while protecting the full value of the debt repayment at maturity. How to do that? Well, the old debt made of bank loans is cancelled for a new senior debt made of bonds with a full guarantee of payments at maturity, roughly 30 years down the road. The principal repayment, the guarantee, is made of zero-coupon bonds invested by the country with the financing help of the IMF and OECD creditors. There is no risk of debt repayment, and the banks can remove the claims from their risk portfolio to improve their ratios of capitalizations. There is a wide menu of Brady bonds and debt restructuring instruments, ranging from discounted buybacks to par bonds, discounted bonds, depending on the bank's portfolio, their client and market strategy, their capitalization, their loan loss reserves, and also the regulatory incentives that are not the same, of course, between the US, the EU, or Japan. But all the debt restructuring instruments are designed to have equal value in net present value. Debt conversion bonds will make possible to swap the bonds for local currency instruments in the emerging market country. That was very popular in Mexico, in Brazil, in Chile. little bit also in the African countries like Senegal. And you can kill many birds with one stone. You shrink the debt, you boost domestic investment and employment, and you beef up tax revenues for the country's government. Looking at Vietnam, for instance, the debt restructuring negotiations of the late 1990s was based on a menu of par and discount bonds, as well as a buyback of bank claims at a 66% discount. And today, Vietnam bonds are actively traded in the markets. Now, once the debt restructuring agreement has been signed between the Ministry of Finance and the banks, well, the bonds will be bought and sold on the capital markets. As you can see, the PDI bonds, previously due interest, have a specific price as well as the par bonds or the discount bonds. And country risk managers and investors buy and sell the bonds depending on their assessment of the future value of these assets. As you can see, Vietnam's Brady bonds are due in 2028 with a bullet payment. But remember, these bonds are fully secured, fully backed, by a zero-coupon bond, hence no burden on the country's balance of payments. The recent debt restructuring of Greek debt closely followed the framework of the Brady Plan with a menu of restructuring options, including buybacks, par bonds, discount bonds, with a haircut ranging between 20 and 65% for the creditors. But everything is not as simply as it looks like on paper. There are always tensions between public and private creditors regarding burden sharing. Indeed, banks and investment fund managers don't want to get treated less favorably than country governments of the Paris Club or than the IMF and other IFIs. And private creditors insist to protect their claims under London or New York laws and not under domestic law of Athens or Kuala Lumpur. Regarding Ukraine's bonds, the yields shot up to 15% in the fall of 2017, despite an IMF financing package and despite a 20% haircut on bonds held by private investors. In the meantime, the IMF keeps calling for the restructuring of Ukraine's debt held by Russia. There is an interesting recapture clause linking investors' revenue to Ukraine's GDP, but between 2021 and 2040, as Keynes said, in the long term, we are all dead. You can see the volatility of spreads looking at yields on Greek bonds before the debt restructuring negotiations and the IMF program. The downgrading of Greece by rating agencies, including S&P's, increased the yield up to 11–12%, that is a spread of more than 8% over German bonds. In the fall of 2017, the yield on Greek bonds has dropped to roughly 5.5%, much better. Bond spreads react to deteriorating creditworthiness or downgrading by rating agencies, but they are not early warning indicators of debt trouble. Looking at Argentina and Russia, we see that bond spreads sharply increased, but during and after the debt crisis and not previously. That's a typical example of herd instinct and contamination. Well, let's look now at what happens after a debt restructuring. Investors and bank claims can be sold in the so-called secondary market, and investors can buy the bonds. They can hold the bonds until maturity, or they can swap the bonds for local currency instruments in the country's economies. Debt trading increased sharply between the mid-90s and 2011, and there is today a growing share of corporate bonds issued by emerging market countries' companies that aim at benefiting of low interest rates in capital markets, and also of the search for yield by private investors. Local currency bonds account for more than half of total emerging market debt, precisely the case of India, Brazil, Mexico, and South Africa. There is a small number of dynamic actors in the market of emerging markets debt trading, including investment funds and also the so-called, vulture funds in the US and in London, the so-called holdout creditors who refuse to contributing to debt restructuring negotiations, and they stick to the original face value of their claims, hoping to recover 100% of their assets. The share of the Brady bonds has declined, and today the bulk of liquid transactions is in local currency bonds, issued by countries in Latin America and in Asia. These bonds constitute a growing and more liquid emerging market debt asset class, including in Brazil and Mexico. Regarding a country breakdown, the lion's share is held by Brazil and Mexico bonds, mainly, as I said, for local currency bonds. In mid-2017, Mexico's government bought back more than $2 billion of local currency bonds with the money it received from the central bank to cut its debt. That's a good deal for Mexico's government, which managed to improve its liquidity and solvency indicators. Today, roughly 70 emerging market countries issue local currency bonds in pesos, in rupees, in dongs, in wons, in rands, you name it. The issuers are both private companies, public agencies, and state-owned companies. Now, who will buy the bonds? Well, interest rates, have been so low since the beginning of the global financial crisis that the search for higher yield has increased the investors' appetite for risk. And Brazil, Chile, Mexico, Colombia, South Africa, or even Vietnam take advantage of this search for yield. The question is there any warning signal of debt crisis? Probably the best tool, as I keep telling you, is an in-depth country risk analysis of the balance of payments and of liquidity and solvency indicators. CDS prices tend to shoot up after a debt crisis or after payment difficulties. In 2017, CDS prices reached record levels for Venezuela, Iraq, and to a lesser extent Greece and Nigeria. But there is little warning to expect from the CDS market that is driven by global market liquidity. There is clearly a correlation between CDS prices and country risk indicators. Euromoney country risk rating provides assessment regarding economic, structural, and political risk. But as you can see, these close relationships between country risk perception and CDS is not an early warning signal. It is simply a correlation, not a causality. Now, when an investor buys emerging market debt on the secondary market of bank claims, the price can be well below the face value of the debt. And the steep discount will be shared between the investor who wants to swap the claims for the maximum value in local currency and the debtor country who wants to capture the maximum share of the discount to reduce its debt to the maximum possible. Hence the basis of a negotiation. Now, what to do then with an emerging market country debt that has been bought at a steep discount on the market? Well, you hold a claim worth 100 of face value in dollars, and you will swap it for local currency at a value between the market price and the face value. And the payment can be made in local currency or in exports of goods and services, or also in development projects in the country's economy. Debt conversion is a good example of a win-win transaction depending on specific conditions, given that the investment in the country's economy will have a range of positive consequences, including an economic growth, employment, and export capacity. But let's keep in mind that debt conversion and privatization for a debtor country mean transferring domestic assets into foreign hands. Think of Greece in 2017, for example. So we shall keep discussing all these issues during the country risk seminar. Stay tuned. Thank you.